Okay, if you do not have any more comments or questions regarding the second final exam, the second midterm, I mean, let's move ahead. So, in the last class, we looked at the flexible budget. The difference between flexible budget and static budget is you have to learn about the standard. In the flexible budget, there is a standard. And according to the standard, yes, and according to that standard, you need to figure out what causes the variance. For example, well, here, there is a variance in the cost. And that variances can be split into two parts, cost variance and efficiency variance. And we need to make a comparison between the cost variance and efficiency variance. Which is greater? I mean, if their directions are different, which is greater? Well, by saying the directions, I mean favorable or unfavorable. The greater one wins, resulting to the final variance to be favorable or unfavorable. So in addition to the flexible budget variance, we also need to consider the sales volume variance. That is for the fixed overhead. Sales volume variance has an impact on the fixed part of the manufacturing overhead. If the sales volume increases, the unit fixed manufacturing overhead decreases, and vice versa. So these two parts, flexible budget variance plus sales volume variance, constitutes static budget variance. That is the difference between the actual performance and the budgeted values. So in the last class, we look at the variance of the material and labor cost. Both variances in material and labor cost are resulted, as I said, resulted from two parts, cost variance and efficiency variance. Well, cost variance reflects the difference between the actual cost of the raw material or labor cost and the actual cost of the labor cost or material cost. Well, the efficiency variance reflects how efficient your labors use the materials or how efficient were your labors are in the production process. We had a little bit left over in the last class. Well, we have looked at the variances in material and labors. There is one more part of the product cost. That is manufacturing overhead. So in this section, we use the terms manufacturing overhead and overhead interchangeably. The total overhead variance is the difference between the actual overhead costs and standard overhead allocated to product. So in a standard cost system, the manufacturing overhead allocated to production is as follows. Overhead allocated to production equals standard overhead allocation rate times standard quantity of allocation base allowed for the actual output. And in a standard cost system, the standard overhead allocation rate replaces the predetermined overhead allocation rate illustrated in the previous chapter. Well, but the concept is the same. It is the rate calculated during the budgeting process when other standards are determined. So let's continue using this example, cheerful colors. Cheerful colors uses a similar approach to analyze the variable overhead flexible budget variance as it did to analyze the direct material and direct labor variance. Remember, the direct material, direct labor are also variable cost. So the approach is similar. I mean, first of all, let's take a look at the variable overhead part. The approach is similar. By saying this, I mean we need to look at two variances caused by the variance of cost and the variance of efficiency. So here is the information to calculate the overhead variance. We know the variable overhead cost standard is $3 per direct labor hour. Variable overhead efficiency standard is 25 cents direct labor hour per batch of grants. Actual amount of direct labor hours is 10,400 direct labor hour. And the actual cost of variable overheads is $30,160. So the variance overhead cost variable overhead cost variance is $1,040, which is favorable. Well, by saying favorable, it means this variance increases the operating income. So next, let's see how this $1,040 favorable variance is resulted. So this is the variable overhead cost variance, and we also need to look at the efficiency variance. The efficiency variance is $7,800, which is favorable. So these two figures added together, we got 8,840. Both of them are favorable. Cost variance and efficiency variance, both of them are favorable. So plus them together, we get 8,840. Well, that is the variable part. Finally, let's take a look at the fixed part. The three production costs analyzed so far are variable costs. So the analysis is similar for direct material, direct labor, and variable overhead. But this company uses a slightly different approach to analyze the fixed part. Here it is the fixed overhead variance. Remember that fixed costs are not expected to change in total within the relevant range, but they do change per unit when there is a change in volume. To analyze fixed costs, we need to compute three amounts: actual fixed overhead, budgeted fixed overheads cost, and the allocated fixed overhead cost. Keep in mind that the budgeted amount for fixed overhead is the same in both static budget and the flexible budget, because fixed costs are not expected to change in total when there is a change in volume. So the first thing is similar to look at the cost variance. The fixed overhead cost variance measures the difference between actual fixed overhead and the budgeted fixed overhead. So this calculation is pretty much straightforward. We use actual fixed overhead minus budgeted fixed overhead. We get $1,080, which is favorable. Well, favorable means the actual amount is less than budgeted amount. But the next step is different. Analyze cost part. The second step is to look at the efficiency variance. But here, remember, total fixed overhead does not change as the volume changes. So here we look at the volume variance. The fixed overhead volume variance. Overhead and the amount of fixed overhead allocated to batch of cranes. Using the standard overhead allocation rate for fixed overhead previously calculated, fixed overhead is allocated at $2 per direct labor hour, and each batch of crane has an efficiency standard of 25 cents direct labor hour per batch. The $1,000 fixed overhead volume variance is favorable because this company produced more batches than budgeted and allocated more overhead to Korean batches than the previously budgeted fixed overhead amount. In other words, based on the standard for fixed overhead, the company has over-allocated fixed overhead by 1,000. The fixed overhead volume variance is not a cost variance. Well, it is a volume variance and explains why a fixed overhead is over-allocated or under-allocated. So this slide graphs the fixed overhead volume variance. Here, the small blue triangle, this part. This small blue triangle. It represents the budgeted fixed overhead, standard fixed overhead allocated, and the standard direct labor hours represented the fixed overhead volume variance for this example. So this part represents the volume variance for the company. So this is how total fixed overhead variance, which is $2,080 favorable, constituted, in which $1,080 is from cost variance and another $1,000 which is also favorable from the volume variance. So next, let's describe the relationship among and the responsibility for the product cost variances. Now that we have looked at the individual product cost variances, let's look at a big picture. This slide shows the flexible budget variances for the product cost. 3 parts: direct labor, direct material, and manufacturer overhead. They are duplicated here for easy of reference. So next, let's try to describe what happened to cause these variances. This slide illustrates the relationship among the various product cost variances. So as you can see here, as we illustrated in the previous slide, three variable parts. They are direct material variance, direct labor variance, plus variable overhead variance. I mean, these three parts. Total direct material plus total direct labor plus total variable overhead variance are pretty much similar because they are variable. But in variable, I mean the total amount hear me now? There's something wrong with my microphone. Can you hear me now? Okay, yes. Sorry, it's my mistake. There's something wrong with my microphone. Okay, let's continue. I just explained the variances, the causes of these variances. Let's take a look at these three parts. The variable part, total direct material, total direct labor, plus total variable overhead variance. These three parts are similar, pretty much similar, because the variance of these three parts are resulted from two causes. One is cost variance, and the other one is efficiency variance. Let's see. Cost variance, and efficiency variance, efficiency variance, and efficiency variance. For the last part, the fixed overhead variance, because it is fixed, let's look at only the cost variance. Well, here, as previously stated, this variance is not a flexible budget variance, but in addition to the cost variance, we still have the volume variance. It shows how allocating fixed costs on a per unit basis causes a difference between budgeted fixed overhead and the allocated fixed overhead. the allocation causes the overhead over allocation or under allocation of fixed manufacturing overhead. But here, the volume variance is not listed because no matter how the volume variance changes, this amount, the total product flexible budget variance, does not change. So that's why the volume variance is not listed here. Now that all the variances are summarized, the company can investigate the variance it feels are significant. This is called management by exception because managers concentrate on the results that are outside the accepted parameters. In other words, managers focus on the exceptions. And the exceptions can be expressed as a percentage of a budgeted amount or a dollar amount. Many companies use a combination of percentage and dollar amounts. For example, a company may investigate any variances greater than 10% of the budgeted amount or 10,000 or more. That so for such company, greater than 10% or greater than $10,000 is regarded as a significant change. So in this case, that company need to investigate what causes significant change. This company will, in this example, cheerful colors investigate any variances greater than 5,000 that direct material variances, direct labor variances, and variable overhead efficiency variances. So here is a table showing the possible causes that causes the so-called significant changes. For direct materials, for example, we can look at how were you able to purchase paraffin at such a reduced cost? Or did you compromise on quantity? Or will you be able to continue purchasing at this time? Or was it a one-time deal? Etc. etc. These are the possible questions that you need to investigate to figure out the possible causes of your quote-unquote significant changes in production cost. And again, by saying the changes, I mean the variance. That is the difference between actual cost and the budgeted cost. That's it. Okay, here is another learning objective of this chapter. That is to record transactions in a standard cost system and prepare a standard cost income statement. So using a standard cost system simplifies the recording process because entries are made at standard cost. Management needs to know about the variances to address each problem. Therefore, this company records variances from standards as soon as possible. This means that the company records direct material cost variances when materials are purchased. It also means that working process inventory, WIP inventory, is debited at standard input quantity and standard cost as crayons are manufactured. So this is a little bit different between what we have learned in financial accounting class. In financial accounting class, the actual cost of, for example, direct material cost, direct material purchases, the actual cost is recorded. But here, the difference is to debit the standard cost. I mean, the budgeted cost. And you need to debit, you need to use another account, that is the cost variance account, to record the difference between the actual cost and the standard cost. Well, let's take a look at of this example. This transaction 1, records the debit to raw materials inventory, which is recorded at the actual quantity of paraffin purchased at the standard cost. In contrast, the credit to accounts payable is for actual quantity of paraffin purchased at the actual cost. Well, let's take a look. This account and this account are two accounts that you are familiar with in your financial accounting class, right? To debit raw material inventory and to credit accounts payable on the account sales. Well, but as you can see, the amount is different. Well, here it is the difference between standard cost, the standard cost accounting and the traditional financial accounting you have learned in your financial accounting class. This amount $113,700 $150. Well, this is the standard cost. And in contrast, this amount, $104,000, is the actual amount that you paid to the suppliers. Well, here is the difference. You record the difference between these two numbers to this account. If it is favorable, you credit. If it is favorable, you credit direct material cost variance. And vice versa, if it is unfavorable, you debit this account. You record the difference, which is $9,750 to this variance account. Well, this is transaction 1, direct material purchased. Transaction 2, direct material usage. Well, this transaction is used to look at the efficiency variance of direct material. Careful colors debit working process inventory for the standard cost of 52,000 pounds of direct material that should have been used to make 52,000 batches. This maintains working process inventory at standard cost. Raw material inventory is credited for the actual quantity of materials put into production. That is 65 pounds at the standard cost of $1.75 per pound. It's here, this part, to credit the actual usage of raw material. The debit account should be working process unit. So let's see. The company's direct material efficiency was 22,750 unfavorable. Should be recorded here. That is unfavorable variance. So this amount the first account, this amount is the standard. there should have been a difference of standard cost and the actual cost. Well, here the difference is unfavorable. To record an unfavorable variance of direct material, you need to debit it. To debit direct material efficiency variance of this difference, which is 22,750. Okay, next, let's see. Let's look at the labor cost. In transaction 3, well, work in process inventory is debited for $12 per hour standard cost of 13,000 direct labor hours that should have been used for $2,000, $52, 52 batches, which is the standard quantity. So this part is the standard part. Well, which payable is credited for the actual cost? Because this is the amount that the company must pay the workers. This part, which is payable, is the actual amount of direct labor incurred. This part. So let's look at the difference. The difference should be categorized into two parts: cost variance and efficiency variance. From the previous analysis, we know the cost variance is 20,800, which is unfavorable. So this part, the unfavorable cost variance, should be debited. And another part is efficiency variance, which is favorable and should be credited. So we credit direct labor efficiency variance for $31,200. Well, let's take a look at this transaction 4, overhead incurred. Transaction 4 records the company's actual overhead costs for 2019. Manufacturing overhead is debited for the actual overhead cost of $54,080, which is the sum of $30,160 actual variable cost overhead and 23,920 actual fixed cost overhead. So let me make a remark. Variable part plus fixed part. And for various accounts, it could be cash, or accounts payable, or accumulated depreciation, or prepaid insurance, and any other related overhead accounts. Next, let's take a look at the next transaction, transaction 5. Transaction 5 shows the overheads allocated to WIP inventory, computed as the standard overhead rate of $5 per direct labor hour, multiplied by the standard quantity of the allocation base for the actual output, which is the standard rate of 25.25 direct labor per batch, multiplied by the actual 52,000 batches sold. Well, next transaction is to transfer the standard cost of the 52,000 batches of grains completed during this year from WIP inventory to finished goods. We debit finished goods inventory and credit WIP inventory for same amounts. The amount equals to the amount you transferred. Well, and cost of goods sold. Same thing. That is the same thing as you learned in your traditional financial accounting class. To debit COGS accounts and to credit finished goods inventory by same amount. So this number is based on the cost of sales at standard cost. And lastly, we need to adjust the manufacturing overhead account and records the overhead variance. All the manufacturing overhead variances are favorable. So they are all credited. The debit to manufacturing overhead indicates that the actual overhead cost debited to the account were less than the allocated amounts credited to the account, and overhead was over allocated. The account therefore had a credit balance and has to be debited to bring to a zero balance. When overhead is underallocated, the adjustment to manufacturing overhead is a credit, and the net amount of overhead variances is unfavorable. Well, this slide shows the key accounts for all of the accounts involved. And finally, this is an example of the income statement. The company's top management needs to know about the company's cost variances. So it shows a standard cost income statement that highlights the variances for management. The variances with credit balance are shown in brackets because they are contra expenses and therefore decrease the expense of COGS. Notice that the operating income shown here is the same as the operating income shown in the previous slides. That is the flexible budget performance report. The standard cost income statement doesn't alter the actual operating income statement, operating income. It simply emphasizes the variances from standard. That's why the operating income, the final operating income, are the same amount. The statement starts with the sales revenue at standard and subtracts the unfavorable sales revenue variance to yield the actual sales revenue. Then, after this subtraction, a favorable sales revenue variance would be added. Next, the statement shows cost of goods sold at standard cost. Then the statement separately lists each manufacturing cost variance. Well, the statement separately lists each manufacturing cost variance, followed by COGS at actual cost. At the end of the period, all the variance accounts, which are temporary accounts, are closed to zero out their balance. The income statement shows that the net effect of all the manufacturing cost variance is 8,320 favorable. Therefore, 2019's operating income is 8,320 more than it would have been if all the actual manufacturing costs had been equal to their standard cost. So that's the end of this chapter. Any more questions? If you have any more questions, you can type in the chat box or simply open your microphone to speak with me.